Hey friends, the topic of today's dividend stock investing video is my watch list. I have been looking back over the past year at some of the big trades that I've made, and I'm analyzing those and seeing how I've done, and I'm thinking, Ian, what is next? What is next over the course of the next 6 months to 1 year? And so I have my watch list that I want to share with all of you today because there's a series of stocks and ETFs that I plan on buying in the next few weeks, next few months. But I also want to take a look backward today and see how did I do on some of my larger trades over the last year. Because some of those trades, some of those stocks that I've purchased, they're still on the watch list. I'm still actively accumulating them. And so I want to start out, as you can see on the screen in front of you right now, with 4 of the stocks that I have shared here on YouTube quite a bit over the last year. And in fact, with the first 3, Realty Income, ALTRIA, and British American or BTI, I've made some pretty aggressive, heavy trades in these particular stocks over the last year. The last position here, Pfizer, I recognized the value, I made a few trades, but I didn't go quite as heavily as in the first 3. And so, in fact, 2 of the positions you see on the screen right now, I still have them on my watch list. And I have a few other positions that I want to share in the next slide that are also on my watch list. But let's start out with a Realty Income. So Realty Income, it's actually the 9th largest position in my portfolio right now at about 4.7% of my portfolio's value. Some of you may remember, and I'll link to it in the pinned comment below, but I made a really huge trade in Realty Income last October in 2023 that catapulted this REIT to the top 10 positions of my portfolio. And that trade, it has aged really well. Not all of my trades do. I share my real story here on YouTube, all of my successes and setbacks as well. It just so happens though that over the last year with these larger trades, I've had a lot of success. So it's been a really good year for this dividend investor. And actually, before I go into Realty Income any further, I want to share on the screen with all of you right now just a post that I shared on social media. And so I'm showing the screenshot here of my Blossom social account. This is actually a social media platform for dividend-oriented investors. It was co-founded by my friend and YouTuber Brandon Beavis. Check out the pinned comment below because I have my affiliate link to Blossom Social. If you sign up through my link, I will get an affiliate commission in terms of full disclosure. It's a great platform. I'm spending a lot of time there. It's very active and it's very much full of investors who are thoughtful in what they do. But I shared this post, and basically to summarize the post, as of late, I'm asking the question, what stock market correction? I'm not seeing a stock market correction really at all in my personal portfolio because dividend stocks like Realty Income, real estate investment trusts like Realty Income, they have been thriving and surging to new levels. I'm seeing capital appreciation, and so my stock portfolio, it's been performing quite well recently. And it's exciting to see that because it shows that the portfolio, it's doing exactly as it was constructed to do, to minimize volatility, to provide consistent cash flow, to provide even some capital appreciation in times that are a little more turbulent for the overall stock market. And so you'll see the stocks today, and I'm sharing some of these with you because they've actually done very well over the last year, which just proves to me that dividend stock investing, the way I do it, it's totally well suited for me because my risk tolerance, it seems to be lower, it tends to be lower, and I'm in it for cash flow. But as you can see on the screen in front of you right now, check it out. So I bought this thing last October at $49.87. Right now it's at $59.32. I'm up 18.9% in capital appreciation alone, unrealized capital gains. In terms of AFFO, adjusted funds from operations, the estimate this year on the low end of the range is 413, which places basically my AFFO-based PE on cost at a 12. Currently, the AFFO-based PE for people buying at current levels, current price per share, is a 14. And so I'm not really buying Realty Income here. I think when I was buying it back at an adjusted funds from operations PE of 12, I felt like I was getting value. Kind of up at 14, I feel like it's fairly valued right now. My yield on cost, which I highlight in yellow, is 6.33%, which I felt was pretty good because it's above basically the treasury rate or the risk-free rate, and it's in very high quality real estate, and it tends to grow over time. The current dividend yield based on the current share price is 5.32%. The kind of moral from the story, I would say, with Realty Income is when everyone else is running, usually running away, that is, I like to run towards opportunities. So last October, people were really down on Realty Income and REITs in general. They weren't doing too well. Everyone was running away. At that time, I was thinking, hey, if everyone else is running away, I better take a look at this. I saw the value. I saw some risk as well. But I think a lot of that risk is starting to diminish, especially as we see possible interest rate stabilization, if not interest rate reductions on the horizon. And so it's nice to see that the investment thesis has played out. And I have received capital appreciation. Now, the downside of the capital appreciation is I don't feel comfortable buying at current levels. The upside of the capital appreciation is it makes me feel good about my investment, that I made the right decision, that I, in fact, recognized value, and I kind of seized the opportunity when that value was there. But again, that's a stock that I bought over the last year. I went into it in a major way. It in retrospect, was a good decision, but I'm not buying more at this time. That one's no longer on my watch list because it has appreciated to a level with an AFFO kind of equivalent PE on current share price of 14. I don't feel like that's where I'd like to be buying, for myself at least right now. So what I want to do next, as you can see on the screen in front of you right now, I've talked about this at length, so I don't want to spend too much time on it, but let's look at ALTRIA. So in the top of the chart on the right, you can see ALTRIA is now my fourth largest position at 7.1% of the portfolio. I went into it in a major way on December 28th of last year. I'm up 27%. On unrealized capital appreciation, unrealized capital gains just since December 28th of last year. That doesn't even account for the 9.75% yield on cost that I locked in because they're paying $392 a year. If I divide that by my purchase price, which was $40.19, I get a 9.75% yield on cost. Now, the current dividend yield is 7.68%. I don't feel comfortable adding to ALTRIA anymore. One, because it's my number fourth largest position and I have a lot of exposure to SIN stocks. But two, because that dividend at 7.68%, it's just a little bit below where I'd feel comfortable buying ALTRIA, especially given that when I bought it, my PE on cost is a 7.88. So I was buying it at such low levels that I was locking in this PE in the sevens. But right now, the current PE on cost, when I take the 2024 EPS estimate of 510 and I divide by the current share price of 5107, I get a current PE of 10. I think a PE of 10 for ALTRIA, it's not a bargain basement discount. Certainly there's risk with this company. I think many people, many politicians even, may wish for this company not to do well. And for those types of reasons, it tends to trade at a lower PE. Even though the business fundamentals, they're pretty good. The business is pretty stable. The recent earnings, they weren't bad. They were pretty good. I think they'll continue to increase the dividend over time on a slower clip, that is, maybe say 2 to 4% range per year into perpetuity. And I locked in that 9.75% yield. But what I'm saying is it's appreciated enough where I think it's fairly valued, all factors considered. But as you can see on the screen in front of you right now, I bought it back when it was at $40.19. So I locked in a PE for myself of 7.88, and my PE on cost, it will only go down over time because the EPS should go up over time, and as EPS goes up, my PE on cost goes down because I'm just taking my purchase price of 40.19 and dividing by the EPS estimate. Those EPS estimates should continue to go up as the years pass. But that was another trade that I made over the last year, and I'm kind of looking at these big trades and trying to understand what's next. What's next for me? Well, Before I can get to that, let's look at the bottom of this chart, BTI and Pfizer. I'm really excited to go over BTI because I have a patron asking me, Ian, it's gone up a bit. You bought it just a few weeks ago for $33.23. It's already up 9.7% in a matter of weeks. Wow. I knew it was going to go up because I saw the stock starting to appreciate. I knew the value was there. And the patron's asking me, hey, Ian, are you still buying? What do you think about it here? Well, let's look at the data. So I bought at $33.23. It's at $36.45. I've made unrealized capital gains already of 9.7%, which helps prove to me at least that my investment thesis, I was on the right track. Now, the EPS estimate in 2024 is 4.62. So my PE on cost is 7.19. Because it's appreciated a bit, the current PE on cost is 7.89. It's still in the sevens. This is why I highlighted in green. BTI, the PE, even though it's gone up 10% since I bought it just a few weeks ago, it's still in the sevens. I don't want to go too heavy here in sin stocks because as I shared in my last video, which I will link to in the pinned comment below, I have a ton of links in the pinned comment below to all kinds of great videos. I don't want to buy too much because I shared how my sin stock exposure by portfolio value and by dependence on cash flow, it's huge. That being said, it's really enticing for me at least to buy a stock like this when the PE is in the sevens. I may add a little more BTI here. This analysis today, I love doing these analyses. I like looking back when I look into the future because it helps me plan for the future. And I'm not going to go with any huge trades probably at this point, but will I pick up a little more BTI here? Hey, I might. It'll be interesting. It's still on my watch list. Check it out on the screen in front of you right now. And so as we look at BTI here, let's go down. My yield on cost, 8.94%, so almost 9%. But the current dividend yield I highlighted in green, it's still in the 8s. If this thing dropped down like ALTRIA, let's say it looked like ALTRIA. If the yield was below 8%, if the PE was up around 10, I would cross it off the watch list. It wouldn't be worth buying here. But because I need yield, I need it a lot. I love yield, dividend yield, cash flow that I can use to pay my bills and to live the good life. Boy, it's hard to find 8% plus yields anywhere right now because the dividend stocks, they've been rallying lately. What stock market correction? I'm not seeing one at all in my portfolio. It's been surging. But I can still get this thing for a PE of 7, 7.89, and a yield of 8.14, 8.15. Count me in. And so BTI, it's still on the watch list. As I look forward over the next 6 months, I thought I was done, but I don't think I'm done. And I'm not done because one of my patrons challenged me. He was like, Ian, look at it. What do you think about it? It's gone up. I looked at it. It's gone up. I'll probably still add a little more. Let's get into Pfizer now. I want to talk about Pfizer, as you can see on the screen. This one I covered back in January of this year. This one's really small. So I shared Realty Income at 4.7% of my portfolio, ALTRIA 7.1, BTI 5.1. Pfizer's less than 1% of my portfolio. It's 0.9% by value, 28th largest position. Real small. But I covered it back in January, and it's gone up since then because I bought it at $28.42 and right now it's at $30.43, but it's only up 7%. I was kind of kicking myself. I wanted to add more to Pfizer, but in a world of kind of constraints, I'm capital constrained. If I had more capital available to deploy, yeah, I would have bought more Pfizer already, but in a world of limited capital, I saw other places where I wanted to deploy my money. But I'm now looking forward. And as I look forward, I'm not buying Realty Income. I'm not buying Altria. I may be buying a little more BTI. I want to buy Pfizer. So this is one that was on the watch list. It's one that I had bought. I bought in a much smaller way than the other stocks on this screen, but I want to buy more. And I did a whole video on this. I'll link to it in the pinned comment below, but I think the company will be fine. And I think they're going to be more than fine. I don't think this is like an AbbVie type of moment, like when I shared AbbVie here a number of years ago, and it was doing really bad, and they turned the business around with their Allergan merger, and now it's hitting all-time highs. Back when I was covering AbbVie, and I'll link to one of those videos as well in the pinned comment below, I was buying that in the PE 7 range. So AbbVie was more like a BTI type of buy. Even like ALTRIA from last December, but no more. ALTRIA is not there anymore. Pfizer, as you can see on the screen in front of you, it's not trading for a PE of 7. It's trading right now, the current PE of about 11.89. When I bought it back in January, 11.10. But is that a real 11? Yeah, not really. I think they will accelerate their earnings. I think the earnings are going to accelerate enough where that 11, it'll probably be more like a 9 or 10 within a year or two. I think it's going to be a great PE on cost as earnings grow over the next few years. That's my thesis as well, as at least. And so we'll see. We'll see how it does. But the dividends right now, my yield on cost when I bought it in January was a 5.91. I'm glad I'm looking at this because the current dividend yield, it's a 5.52. I highlighted in green because I could really use that. My portfolio-wide yield right now, current yield is like a 3.89. I want to increase that to maybe about 4.5%. So I like buying stocks like Pfizer and BTI that increase my overall portfolio yield. At 5.5, it's better than I thought it would be. Here's what's so interesting about the stock market. When you own as many positions as me, sometimes you just have to put it in Excel and look at the numbers. Because in your mind, sometimes you start thinking about scenarios that didn't even play out. Pfizer, for example, I think its low was like down in the low 20s, like 24 or something. I don't have it in front of me, but it was really low. I looked at the stock chart recently and at the price, and it was at 30. And I'm like, oh boy, I wanted to buy it, but I missed my chance. But then I just look at the data. Where did I actually buy it? I didn't buy it at 24. I bought it at 28. It's only $2 cheaper back then than where it is now. It's only at 30. And so, yeah, I missed the bottom, but have I missed the top? No. And so sometimes just looking at the facts on paper proves to myself that I didn't miss the boat here. Yeah, it's gone up, but I was willing to buy it at 28. I'm willing to buy it at 30 right now in this market at a yield of 5.5%, which does a lot of good for me as a qualified dividend. And so I have Pfizer right now solidly on my watch list. I do plan to add to that position as well because it provides meaningful cash flow that I can use right now. And so I have a few other positions though that are on my watch list that I want to share with all of you. These are ones that I didn't do as much math on them. I just want to share them in kind of a more conversational manner with all of you. But I have a few ETFs, a few stocks in there that I want to share with all of you. By the way, before I get to that, if you enjoy the video so far, please go ahead and click the like button. It would mean the world to me. I'm here in the office on Sunday filming this video, preparing for this video, filming it. Hopefully have some time to edit it and get it live as well. It was a busy week last week. I was traveling, so I didn't have time during kind of the normal hours I allocate for YouTube, but I'm here on a Sunday to do this video because I love you all. And I can't wait to see you in the comments below as well. But let's check it out. As you can see on the screen in front of you right now, I want to share what else is on my watch list. And so I have, first and foremost, it's no surprise, SCHD. I've talked about it at length. I'll link to a recent video on SCHD in the pinned comment below. This is my number 20 largest position at 1.5% of my portfolio. I'm not going to rest until it gets into my top 8. It's going to be hard for me to focus on too much else until I just get this done. I don't have a lot of fun buying SCHD, but it has to get done for the sake of increasing my portfolio-wide CAGR and diversification. It just has to get done. And it's not fun, it's not exciting, it's not as fun as individual stocks, but that's number 1 on this watch list as I add to those stocks from the last screen. And again, from the last screen, not all 4 on the watch list, just BTI and Pfizer. Next one is StarBUX. I share all my trades on Patreon, by the way, which I'll link to in the pinned comment below. I recently made another trade in StarBUX, but so many people right now have just written it off. They've moved on. I watched their recent earnings. I thought they were okay. They're starting to turn things around. I don't think this is going to be a quick turnaround. I think the company right now is a reflection of the economy that we're in. And this is an economy where consumers, they don't have quite as much money to spare as they did in the past. And we're seeing this not only with Starbucks, but with other fast food restaurants as well. I think we're going to see some interesting times ahead. Usually the Federal Reserve waits a little too long to cut rates. They probably should have done it already, but they're waiting a little longer. I think these prevailing higher interest rates, they're starting to slow down the economy a bit, which was the intended consequence. And we're seeing reflections of that in stocks like Starbucks. I'm in this for the long run. I'm in this for many, many decades ahead. I just read the book, Pour Your Heart Into It. I did a book club meetup Zoom on Corner Patreon, and we shout out to Brandon and Marcus who attended. It was a lot of fun, and we discussed the book. One of the things about Starbucks when you read a book like this is it's been through so many ups and downs throughout the decades that what they're facing now seems like nothing. And what was one of my biggest takeaways from the book is when they started in the 1980s, Starbucks basically invented the category of Italian-inspired espresso here in the United States. Before then, it didn't really exist as a widespread thing. It took a lot of education and a lot of perseverance, a lot of creativity, a lot of hard work, a lot of risk-taking to bring that business to fruition here in the United States, to invent a whole new category of business. But by inventing something new here in the US, they earned the rewards of that, which created this huge, huge company. What they are doing in China right now reminds me of what they did in the US in the 1980s. And I would say not only in China, but elsewhere internationally. I have big hopes, high hopes for Starbucks as well in other countries like India. Over the coming decades, if they can invent premium Italian-inspired dark roast espresso and really corner those markets, gain market share, own those markets in China, in India, and elsewhere throughout our world, I think that this company eventually could become a $200 billion market cap. This won't happen overnight, but that's my projection for the next 10 or so years. And if they are successful in that, of course, the dividend will follow, and it will grow and it will compound. And so as you can see on the screen in front of you right now, even though it is one of my largest positions already, I am buying Starbucks. I believe at a PE here of 21.20 on a forward 2024 basis, I'm getting a fair price given the growth that is ahead for them. And I love the starting yield of 3%, which is pretty great for Starbucks. So SCHD, Starbucks, you've heard about those quite a bit. I'm looking at another one called FOF. This is a closed-end fund. It's yielding right now 8.59%. This would be a net new position if I added it. I need to be careful with this one because I would be buying it in a fully taxable account, not a retirement account. And it's a closed-end fund and could have some tax consequences for me. I may just buy this to kind of get familiar with it and see, like, what is the tax situation like? How does it go? Is it create a lot of complexity, not a lot of complexity? But so many of you remember, I interviewed my friend Greg, the dividend monster, over on Instagram. I'll link to the video, the interview in the pinned comment below. I also reviewed a book he recommended by Stephen Bavaria. I'll link to that book review in the pinned comment below. I have so many resources here. Please go ahead and subscribe to my channel if you haven't already. I have over 400 videos here on dividend investing, and I hope you enjoy them. Make sure to check out the pinned comment because I linked to some of the ones I discussed in the video today. But ever since the interview with Greg, I've been thinking in the back, and I read The Income Factory, I've been thinking in the back of my mind, how can I add elements of the Income Factory to my own portfolio? And I've been thinking about different closed-end funds, different strategies. At the end of the day, as you can see on the screen, the reason I like FOF is it's a closed-end fund of closed-end funds. It holds, I think, like 100 different closed-end funds under it, and it would give me broad exposure to closed-end funds. And it's kind of like SCHD in some ways. It's well diversified. I don't have to become an expert at picking closed-end funds. I just buy the one closed-end fund, and I get monthly payouts with a starting yield of 8.59%. That starting yield was higher just a number of months ago when I first started looking at it. But hey, I chose, this is just an interesting takeaway as well. I chose other opportunities. Instead of buying FOF at that point, I bought ALTRIA. Well, I'm up on that. And so I could have been up on FOF, but I live in a world of limited capital. And when I live in a world of limited capital, and capital's coming in lumpy manners at different times, I just have to deal with the cards I'm dealt. I just have to deploy the money as efficiently as I can at any given moment in time. That's why I like a watch list that has a number of positions. I have a watch list today I'm sharing with all of you that has 6 positions. It is BTI, it is Pfizer, and as you can see on the screen, it has SCHD, it has StarBucks, FOF, which I just discussed, and last but not least, it has DIVO. DIVO is an ETF that offers covered call exposure. I just reviewed this in a recent video, so I will link to that in the pinned comment below. Yet another link. But this one is solidly on the watch list as well. I don't even want to go into this because I just did a whole video on it. A lot of people, I think, missed that video, so make sure to check it out. It was a really good one, in my opinion. But this one would offer a starting yield of 4.45%. Other than StarBucks and SCHD, the other 4 positions on the watch list right now would increase my overall portfolio yield. And SCHD and StarBucks, they're a little lower, both of them, than my average yield of the portfolio, but not too much lower. And both of those presumably would be adding to my CAGR. Because I have 2 goals right now. Gaining more overall portfolio yield while also simultaneously increasing CAGR. And so all 6 of these kind of fit that theme. But before I go today, I have a few stocks I analyzed that did not quite make it to the watch list. Check it out. I own these already. These are stocks I like, but I want to share with you really quickly why I looked at them and they're not on the watch list. And so as you can see, the first one is General Mills. I like it. It looks cheap right now. Forward PE of 15.43. It has a dividend yield starting of 3.46. However, the reason I'm passing on adding more for now is I already have too much exposure to CPG food. You can see kind of in the stocks, other than BTI and StarBucks, perhaps, they all offer lots of diversification into areas where my portfolio lacks. Healthcare with Pfizer, I could stand to have more healthcare. SCHD gives me broad exposure, including a lot of exposure to the finance sector, which I don't have a lot of exposure to. FOF would be a whole new thing into closed-end funds. DIVO would be a whole new thing into covered calls. And so I pass on General Mills right now just because I have a lot of CPG food. Some people have called me CPG Ian instead of PPC Ian because I have so much. Honeywell. I like Honeywell here at a forward PE of 20. The yield, though, is just too low for my purposes at this point at 2.12%. No matter how fast they increase it, 2.12% ain't going to cut it for me right now where I'm at in my life. But I like Honeywell if I were a younger Ian, maybe if I were back in my 20s or 30s, I'd probably be buying some Honeywell here because I could use more exposure to industrials. I've also been looking at BMO, Bank of Montreal. I love that starting yield of 5.56. It's enticing, but I don't want to pay foreign tax with holdings at this point. I already own it. I already deal with it, but kind of tired of it. And I can get bank stock exposure from SCHD. And so those are 3 stocks I did take a close look at. I already own them. I like them. I'm not selling them. But I decided at this particular point in time, hey, I'm not going to add more of them. I'm going to pass on them. So what about you? Put in the comments below, is there anything on your personal watch list these days as you look forward towards closing out this year? Because now we're more than halfway through the year. We're kind of closing in here. We're going to finish out Q3 pretty soon and head into Q4. It's just around the corner. What are you looking at to close out your year? This is kind of what I'm looking at. With that, before I go, I want to add a full disclosure that I own the stocks mentioned today. I am long Realty Income, ticker O. I am long Altria, ticker MO. I am long British American, ticker BTI. I am long Pfizer, ticker PFE. Also, I am long AbbVie, ticker ABBV. I'm long SCHD, which is my favorite dividend ETF. I am long StarBucks, ticker SBUX. I am also long General Mills, ticker GIS. I am long Honeywell, ticker HON, and BMO, ticker BMO. I may decide to add some new positions soon. One of them is FOF, and one of them is DIVO, DIVO. And so that's where I'm at with my disclosure. In terms of a full disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. I'm not offering any kind of financial advice. Thank you for watching my video. I love you all, and I will see you all in the comments below, and I'll see you in the next Dividend Stock Investing video.